Today, my name is Ryan Mummert, and I am the host of Market Movers. And I'm excited today because we have a visitor from New York, and his name is David Flores Wilson with Sincerus Advisory. Welcome, Dave.
Great to be here, Ryan.
I've actually known Dave a long time, since the high school days. I won't put a date on it, Dave, but you look much younger than me, so congratulations on that. I appreciate it. And the hair has survived, so yeah. I really appreciate it.
Well, you have three wonderful children, and I think that's why I look younger.
Yes, they do age you, so thanks for the shout out, right? And in terms of keeping me young. But the reason why I'm excited is because, you're kind of... as one of our old coaches would say, Guam boy made good, right? So you're someone who was born and raised here, but then was able to scale onto the national stage. Can you talk to me about your journey to where you are now with Sincerus Advisory?
Sure. We founded Sincerus Advisory about 3.5 years ago in the midst of the pandemic. Have about 20 years of financial services experience. After college, I took a job in investment banking, and I did that for 8-9 years before, jumping into the financial planning world at a small firm. And then what happened was, essentially, I was building up a client base there, and having some success there. And as the pandemic came around, sort of thinking to myself, if something were to happen to me in this situation, do I feel pretty good about the clients being taken care of at that firm? And frankly, the answer was no. So, there's a gentleman I met socially, maybe 15 years ago. We became friends. We were always talking shop, and then we decided to team up in the pandemic and start this company.
Ah, that's awesome. Hold on.
I can jump in a little bit of what the company does and stuff. I don't know too.
Okay, yeah. Sure. Go ahead.
Yeah, and so at Sincerus, we do personal financial planning for families. We work with about 120 families right now, about 150 million or so under management, and essentially, we put together financial plans, and then we give them strategies and techniques to make progress on those plans, and then of course manage their money. And so in general, the profile is just couples that are hitting their stride in their career and their businesses, and they want to retire early, and they want to go on great vacations and put their kids through great colleges. And we come in and alleviate some of the stress and help them plan. And it's kind of interesting because so many of the clients they're smart enough to do it themselves, but they bring us in and we do it for them. So
nice. So 150 million under management?
Yeah, give or take what the market's doing.
Well, that's significant in that, you essentially started from zero, right? So can you tell me about the skills that you leveraged to kind of build from zero up?
Sure. I think that, what I will say is that there's just lots of different ways to be successful in this business, like in any business. And so for us, what's helped for me is that, really two things, right? One is just a constant desire to help people, right? I think that there's so many different situations that clients are in. There's so many judgment calls. And so clients just really appreciate the objective advice, being as comprehensive as possible. And as well, I think this, what's helped me, a little bit of a differentiator is just the commitment to lifelong learning. And there's, in terms of table stakes in our business, right? There's the investment piece of it, the retirement piece of it, taxes, estate planning, insurance, as well as, philanthropy, college education, and even sort of advice to business owners as well. And so, what we can do for clients is, it's unlimited in sort of what we, could learn and sort of offer in terms of advice. So, you just kind of, you chip away at it, you keep learning, whether through the books and the podcasts and the conferences and the webinars, and then, just like it's, compound interest, right? It just kind of builds, and one day you're like, oh wow, I give pretty good advice. So.
Yeah, no, I appreciate that you said compound interest, right? And that's something thematically I like to kind of build on, pun intended. but I guess the idea that incremental gains, being able to be leveraged to the point where you can scale. What would you say is your professional superpower?
Yeah, no, I think for me, like I said, it's lifelong learning, right? And I think just chipping at it like every day, in terms of just being curious about different aspects. I think, for example, the Tax Cuts and Jobs Act in 2017 was passed in December of 2017, and there was a little known provision called opportunity zones. And so I read about that, rolled up my sleeves, read the law, contacted the attorneys and CPAs I know that could be helpful, and then just build up my expertise in there, and then just go out to the client base and people I know that might benefit from that knowledge. And then that's just a repeatable process, right? The laws are always changing. There's always new opportunities in the markets, in estate planning, in philanthropy, and so when you do that, people can see the value and they refer people, and it kind of builds from there.
I'm glad you brought up opportunity zones, because I mean you were one of the people who really opened my eyes to that. And Guam is a giant opportunity zone, right? Can you speak a little bit to what that is?
Sure. Yeah, I think some of it's twofold in terms of the benefit, right? I think originally there was a tax deferral of the gain until 2027, and then once you reinvest that gain, if you hold for 10 years, then you're not taxed on the capital gain on that sort of reinvestment of the gain. And so a little bit of a play on 1031s, right? In terms of except with 1031s, you're reinvesting the principal as well. And so I think it's been a tremendous sort of opportunity for people that have large capital gains, and can minimize their taxes and invest in good projects, right?
So to restate that, I can invest in a gain into an opportunity zone and get any return from that investment tax-free for a period of time.
Yeah, let's say you bought a property for $1 million. It's worth $2 million. You sell it for $2 million. You have a $1 million gain. You reinvest, actually just the gain part, the $1 million. After 10 years, let's say that $1 million turns into $5 million. There's no capital gain on the $5 million minus the original basis of $1 million.
Yeah, that's an amazing vehicle to defer tax. And what I like about it too, as you've educated me on, is that that with that investment, you don't have to worry about some of the restrictions that you would have with a 1031, such as commingling of funds and the time horizon to reinvest and reacquire the replacement property.
Yeah, no, I mean, I think the focus really was I think it was bipartisan, when it came to that legislation, right? It's sort of senators from both the Democratic and Republican Party were for this, and each of the states and the territories were able to designate the areas of need, right? And that the census tracts that people could invest in, and I think in some areas it's been more prolific than others, but for sort of the nationwide gentrification, right, really was sort of the aim of the legislation. So
okay, well, I'll ask you this: stocks or real estate, Dave?
You cut to the chase.
Yes,
right? So
yes. I'm a very direct person.
Yeah. I think that, it depends, right? Not to sound like a lawyer, but it is, I think when it comes to stocks versus real estate, I mean, what's important is, you start with the actual investor, right? Like, what are their goals? What do they want to accomplish? And what are their values? And then, we like to kind of think about investments and capital allocations, sort of, okay, well, you might have some sort of risk-free assets like your checking and savings accounts. You might have some market assets like your brokerage accounts and 401ks, and then you have your sort of aspirational assets. And so, when it comes to that push and pull between real estate and stocks/bonds, it's that sort of push and pull between that market basket as well as that aspirational basket. And so, person has to really understand, are they really a real estate investor? And so, real estate investors have to be, they have certain comparative advantages, right? And so what kind of investor are you? Are you someone who has, better access to capital? You have those relationships with the banks. Do you have the ability to sort of renovate quickly and cheaply? Are you that kind of person that can identify the surging demographics, right? I have a friend in New York City that, he bought an apartment in the meatpacking district in the early 2000s. In the late 2000s, he bought something in Dumbo, Brooklyn. Then he moves to LA and he buys in Silver Lake, California, and in Los Angeles. And he's just got the hot hand, right? And so you just have to know who you are. And so those people who have those particular skills in the real estate, I would say, yeah, you're going to lean towards real estate. And it's not a sort of a zero-sum game because, your liquid portfolio could help out your real estate portfolio, right? Your liquid portfolio could, be a source of capital. You could have a line of credit against your liquid portfolio that, you can then use to buy real estate. Conversely, your real estate portfolio could be a hedge against, potentially a bear market, right? Where, last year we had surging, rental rate increases in New York City when, the markets weren't that great during parts of the year. So, it's a complicated question. I think that people just really should break it down and understand their balance sheet and their particular goals and their situation. But I think real estate is unmatched when it comes to the tax advantages, frankly, right? And so, the ability to sort of, you buy real estate, you can, you do renovations instead of then capitalizing that over the life of the property. If you can just expense that right away if you don't sort of rent it out right away, right? And then you rent out the property, you have incredible depreciation. You might do that over 27 years. You get a cost segregation study, you can do that quicker. When you're selling real estate, of course, you can do 1031 exchanges, opportunity zone funds, and on and on and on. Like we can get into having a spouse be a real estate professional and having those losses in real estate go against W-2 income for the other spouse. But at the same time, we have those sort of drawbacks of real estate in terms of the inability to sort of diversify easily, the personal liability, as well as just demands on your time, right?
But that's what you do. That's your approach as a financial planner. Is you look at all these buckets and you put it all together into a package that makes sense for your client.
Yeah, no, I mean, a lot of times what will happen is, a client will come to us and say, hey, I'm thinking of investing in this. And that could be, we had a client the other day, actually it wasn't the other day, it was about a year ago, because they wanted to invest in Back to the Future, the Broadway show.
Oh, okay.
Right? So, I've never invested in a Broadway show before, right? So, but here are 5 things to think about, right? And that show was actually running in London. And I was like, well, why don't you spend $1,000 for the weekend, go to London, see the show, and then decide whether it's worth investing after that. And, frankly, it hadn't occurred to him.
Right.
And so, on the real estate side, people come to us with these projects and, we'll just ask them questions, right? And we'll sort of say, hey, okay, well, let's model this out together. Is this right for you? Is this what's the risk of this type of project? And then move forward or not.
And it's great to have that voice to kind of bounce things off of, especially with someone who knows your complete financial picture and the way you're structured.
Yeah.
And what
I don't have all the answers, so I'll just be very clear, right? And I always sort of bring my own personal biases, and so and sort of the experience that I have, and frankly, sometimes it's better be lucky than good, right? In terms of sometimes people shoot from the hip and have these real estate projects and they work out great, and other times they really don't. So we just want to bring these frameworks and say, hey, okay, well, these are things to think about in the context of your situation, and the questions to ask, and the assumptions that we have to sort of tease out, and et cetera.
Okay. Well, you mentioned podcasts and lifelong learning. Can you talk about 3 books that you feel have influenced you recently?
Sure. There's so many great authors and thought leaders that have influenced me in different times in my life. I think that, and I'm not particularly one of these dogmatic people that will kind of read a book and kind of go all in and be like, oh, this is the book for me. I'm going to run my whole life and my business by that. Right? It's just not really. God bless the people that do. Right? For me, I do have a little bit of more, a little bit of skeptic sometimes, right? When it comes to sort of But, there's just so many different things, right? I think early on, David Swenson, who was the head of the Yale Endowment, his book, Unconventional Success, influenced me when it came to, how to think about investing around asset allocation, keeping expenses low and time horizon, all sort of these different things. As well, it's not a particularly well-written book. There's a book called The Partnership Charter that, was instrumental for, prior to me taking on a business partner. And I really recommend it, sort of thinking through the what ifs of, different scenarios, when you work with a business partner. More recently, I think there's a book called Who is Michael Ovitz? And, who is Michael Ovitz, right? He's a venture capital partner right now, but he was the number 2 person at Disney.
Right.
And originally, he founded CAA, which was there's just the Hollywood super agency, right? And so, and he did a couple things that, one, he sort of revolutionized the business, right? Because before the big studios were like, oh, get me an actor, and you send an actor, and they kind of put the projects together, and he kind of flipped it on its head and said, hey, I'm going to get this great director, I'm going to get this actor, I'm going to put it together as a package and then send it to the studio. And it really reversed the power dynamics in the industry. But what really had an impact on me was just his approach to the business and sort of, and how he worked with clients, right? And so, his approach was to just overwhelm the client base he had with expertise. And, prior to him starting CAA, it was more of a superstar model where people just kind of, ran their own little businesses. But he really thought through teamwork and collaboration and sort of, and just going above and beyond in servicing sort of his clients. And so, I think when I read that book maybe like 4 or 5 years ago, I'm like, I'm going to open my business. I'm going to run it this way.
Oh, cool. Dave, what lesson have you learned that has helped you most on your entrepreneurship journey?
I've been an entrepreneur now, 3.5 years, right? And what's interesting was that prior to that, I actually was, advising entrepreneurs without actually being one. And it's just a different game, right? When you sit in that same seat and you think through what an entrepreneur does, what we have to personally do in our businesses, and it really just has helped. But in general, I think that, there's just a lot of, there's a lot of things that, people can benefit from, right? And so I think that for me, it was getting the right team together, that being, my business partner and employees, and as well as, professionals that help us, like attorneys and CPAs. And I think, as well, a team, not just those professions we hire, but also, different mastermind groups I'm a part of, just where you can just kind of bounce off ideas, get that objective, sort of non-judgmental advice, and sort of get some guidance there. But I think, there's just lots of different ways to be successful. And I think that, there's, all these sort of tidbits that have helped me along the way, protecting my time, other things like that. So.
And that's something I personally internalize, just in terms of watching you develop professionally, is having those groups, having those buckets, being able to connect people to the right answer, being able to bounce these ideas off someone who will give you honest and informed feedback versus, twisting in the wind or trying to take it, from some kind of professional development book. Can you tell me who or what has influenced you the most along your professional journey?
Sure. I think, the biggest impact for me has been my family, right? So, my mother, she really just, she cares a lot about people. And I think that, I'm half tomorrow like you, right? And so that was a very different culture than I'm sort of exposed to from my father's side, right? And so, and just taking those values I learned on this island about helping people and collaboration to New York, I think has just been so helpful, right? And it really differentiates me in that marketplace where people are, a little more focused on themselves, frankly, right? For better or for worse. I think, my dad, he was a CPA. He still is a CPA. And he had an office in our home, and I saw, that he was given, objective advice to people, and, that was very impactful to people. And they really saw him as this trusted advisor. And, I even saw that, he was just so honest about things that, he wasn't ever telling people what they wanted to hear, right? It was just, as well, my grandparents, Alfred and Esther Flores from Minarajan, they had a great impact to me. I worked every summer and weekend on that farm that they had. They had a series of businesses. They were, pillars of the community. They, were the hardest working people I knew. Really emphasized family, and so that really influenced me. And I think, as well, something happened where sometimes actually bad things happen to good people, right? And so, I saw that they didn't. I was very young at the time, and they didn't have adequate planning, and they had there was an accident in one of their businesses, and they lost one of their businesses, right? They didn't have the proper liability insurance, right? Fast forward, they didn't have the proper estate planning in place, right? And so, on their deathbed, they, I had a cousin who used a fraudulent obtained power of attorney and stole some of their property. Fast forward, that's in litigation still to this day, even though they were found guilty. It's going through the appeals and stuff. So, what I do really is, to prevent that from happening, right? So I want to be comprehensive in the planning. I want to look at it every angle, so that doesn't happen to any of my clients.
Right, and you're not competing with your real estate advisor or the realtor or anything like that, because I think sometimes the dichotomy is like there's a push and pull, right? If they're not using the money here, they're using the money there, right? But it's really a team approach. Yeah,
absolutely, and I think we collaborate a lot with these other advisors, and so sometimes it's just so obvious, right? Like that. Wow, you're able to find that real estate project, and it's 1.5x times what the market has done over the last 50 years. Like let's do that.
Right.
Like I don't care that I don't manage that money, right? Like let's grow your overall balance sheet. And yeah, it's great to have liquid funds because you can get those funds like in 2-day settlements and if you need to, and in case of an emergency. But the push and pull is really not there from our perspective if you're sort of giving the objective advice, right? And so, the real estate's great. So.
I have $50,000 under a mattress or in a savings account. Yeah. What are you saying to me?
No, we have to dive deep on that, right? You can't sort of just say, hey, take this 50,000 and put it here, kind of thing. I do think that there's, for the first time in many years, is an interesting opportunity in cash, right? And I think, T-bills are yielding 5% or so. And if cash is the right thing for you based on your risk tolerance and overall balance sheet, you should probably not have it in a savings or checking account earning less than 1%, which, a lot of times we've seen that.
Yes.
It should not actually be earning less than 2 or less than 3 or even less than 4%. Open an account at Schwab or Fidelity or whoever it is and earn that 5% if cash is the right thing for you, right? So.
Understood. So you heard it here first, savings accounts are for losers.
I didn't say that.
Yeah, that's what I heard.
Well, yeah, I mean, I think what happens is that, the cash markets evolve, right? So, right, like there was a point when the banks, at least some banks were earning more than money market, were earning more than T-bills. And so, that's why you got to be watching these different markets, talking to people, have the right advisor, have the right CPA, and just maximize your money. So.
Hey, and it really is a team approach.
Yeah.
Yeah, I agree. Dave, what tech do you use to manage your finances? You use an app or anything like that?
Yeah, personally, I mean, we use a software called eMoney, which they actually were purchased by Fidelity, but it's still running separately. And so that software has, you can run projection models and what if statements on, okay, if you buy a $1 million house versus a $600,000 house, that mean you have to sort of retire 5 years later, or if you're saving X amount versus Y amount, what that does. Frankly, there isn't commercially available consumer-facing software that is adequate and robust enough. Frankly, in today's market, there's definitely an opportunity, and with people working on this, I know it'll happen eventually. But that's the software that we use right now. So,
yeah, I was looking at I've used Mint before. But I've looked at some of these other software that incorporate AI into the model, and they're, in some instances, the AI actually talks trash to you. It's like really the third latte this month? Come on, man. That's kind of interesting. The role of AI coming into play.
Well, it's interesting you say that, right? Because it's a lot of times we just have to be objective and be non-judgmental, right? Mm-hmm. And so we see what people spend and. Sometimes things are not prudent, right? But I mean, we're human, and so when it comes to budgeting, everyone hates the word budgeting, right? Like it's just like essentially what budgeting is just knowing where the money's going before it comes in, and so when we do that and when we help people with that, it's just like, okay, well let's be real. You're human. Like let's have this amount, a realistic amount for play money, for entertainment or whatever it is. Because I think a lot of times, people just get such anxiety around budgeting, and so they don't make those decisions. They don't do those analytics around it because they're kicking it. They just don't want to do it, right? And so as well, financial literacy is such a problem in this country.
Agreed.
Right? And it's taught in the schools. There's very few college courses, let alone like high school or secondary school, and so. This is a huge problem. We're asking, 17-year-olds to decide where they want to go to college and take on six-figure debt. We have the first sort of classes of people entering retirement age and collecting Social Security that still have student loan debt. It's a huge problem, and I think that we want to do our little part, right? Like that's why I started the blog back in the day, planningtowealth.com. Just take some of what we know, put it in article form, just put it out there on the web, and people can kind of do some of these things themselves. And there's something like one CFP, one certified financial planner for every 3,000 Americans, and it's very sad in terms of just these stats that we see about the average American having X amount of in their savings account or investment account. We need some answers here.
Well, I mean, I think from a consumer standpoint, we have a society that believes heavily in leverage.
Yes.
Right. And over leverage.
Well, I mean, also not to go, we have so many, the smartest people graduating from college and big tech, and now AI, just like, manipulating us into sort of buying things. We've always known about the perils of advertising, but now the stakes are higher and the algorithms are much more complicated and much more sophisticated. And so, doing the right things financially, it's more difficult. But I always encourage people that, essentially there's sort of 5 levers of financial planning, right? You can invest, you can save, you can protect what you have, you can minimize debt. And then you can you can manage debt correctly, not necessarily minimize it because there's good debt and there's bad debt. And then you can minimize taxes. And so of those 5 levers, most people are kind of doing maybe 1 or 2. If you're doing 2 or 3, great. If you're doing 5, amazing. So.
What do you think of Dave Ramsey and the no debt principle?
Yeah, no, I think to speak to that there isn't formal financial literacy education out there, right? And so most people are just, they either have to learn it themselves, learn by doing, or maybe they're drawn to some of the financial influencers and financial media personalities are out there, right? And so, and this, like in any marketing, right? Like it's the extreme positions that take the most amount of get the most amount of traction.
Yes.
And so, I think Dave Ramsey has done a lot of good for financial literacy generally. Do I believe in a few topics that he's completely wrong? Yes. And so, I support him and other people like that are spreading financial literacy. And but yeah, he has some very dogmatic opinions. Staying patient and diversifying and boring investing, that just doesn't make the news, right? So
right, I understand. Well, I would personally pay you extra to roast me every time my coffee spending gets kind of crazy, or I spend too much eating out, over, and you do, Dave. Thank you. But soon the AR will replace that aspect of it.
Yeah.
Dave, looking back, from an entrepreneurship standpoint, what advice would you give yourself if you could go back in time and talk to yourself before you kicked off Sincerus Advisory?
That's interesting. I look back actually when I was doing investment banking, and I think it was I'd been doing it a number of years, and I think by 2005, I'd taken a few certifications. I'd taken the CFA and a couple other things, and so what was happening is that some of my coworkers were coming by and they were saying, "Hey, I heard that you took this certification. Can you tell me what to do with my 401k?" And then I'd kind of developed this rent versus buy spreadsheet, and people in the office were coming by and say, "Hey, can you send that spreadsheet to me? I'm maybe thinking about buying a place." And so what I realized that financial planning was my hobby, and that it was my passion, and that while I enjoyed working in investment banking and met some insanely smart people, it wasn't what I wanted to do for the rest of my life. And so what did I do when I found my passion and I found my calling essentially is that I waited 3 years, right? Okay. I did the absolute thing you shouldn't do. And so so finally, the financial crisis came, and circumstances. I was laid off in investment banking in 2009, and that was the point I started to be a financial advisor. And then, of course, a number of years I always sort of thought about doing entrepreneurship, and didn't start this company until 2020. So for me, it's like, wow, I would just go back and do this company and do this since day one, right? Because that's what my passion. I wasn't ready, sort of mentally to make that leap. But that's what I would tell myself.
For the record, Lehman wasn't David's fault. He was in the bond side, so he didn't take on any of that.
Yeah. No, I mean, it's just that old adage, right? It's just, what is it? Buffett that says the two big problems are too much debt or too much drinking, right? And so it's probably a little of both in the management team at Lehman, right? So
golf, I think. This is golf.
It's just, I mean, I think that I worked with a lot of smart people there, and people. For me, it was very fortuitous, right? That was the impetus that forced me to be like, oh no, you've been talking about doing and going in the direction of your passion, and this is going to force you to do that. And for me, I got very lucky. So
that's awesome, Dave. Dave, can you tell me about any emerging market trends that you see, in the coming year?
Sure. We're a couple of years past COVID, right? And I think COVID was so impactful for a lot of ways. At the personal level, the economy globally. And so, we're still feeling a lot of the reverberations for that, right? And so when I think about the markets, we had, in many ways, inflated markets based on sort of, free stimulus, lower interest rates. So we had, in this new year, fundamentally, the valuations aren't great. We have a lot of debt in this country. Yet at the same time, the U.S. economy and the U.S. markets, have some things going for them that, really can't be replicated anywhere, right? I think the brand of Hollywood gets people to kind of want to move to the U.S. We have Wall Street has this sort of great capital allocation model, and there's something about the U.S. where U.S. students don't get the highest test scores worldwide, right? But there's something about being in America and sort of questioning enough and bringing having the right amount of education, right, and sort of as well as sort of the diversity of the population. That you look at sort of the top 10 most valuable companies in the world, and you're like, wow, most of them are U.S. based companies, and so and then we have Silicon Valley, sort of just funding startups and consistently creating great companies. So I'm always hopeful and sort of bullish on the U.S. generally, but at any given point, of course, price matters, right? And so I would just as I look up next year, I think anything can happen, right? And it will happen, right? The geopolitical issues we experience, it feels horrible, always in the moment, right? In terms of just whether it's Ukraine or Israel or whatever's going on in the world, but at the end of the day, when it comes to markets, it's a function of corporate profitability, and I'm sort of bullish long term on that. So
good. All right. Well, Dave, I would just want to say I appreciate you coming out and spending some time talking real estate, entrepreneurship, and investment with us. Tell us where we can learn more about you and your investment philosophy and your company.
Sure. Yeah. You can go to the blog at planningtowealth.com, or just Google David Flores Wilson, and it'll send you to the company website, Sincerus Advisory. And always love to talk to people. Take a 30 minutes, talk about their situation and see if we could be helpful.
Right. And Dave doesn't just exclusively represent people out of New York and nationally. He represents people locally, right?
Yeah, no, most of the client base of, basically in 3 areas, right? In New York City, California, went to school, and in Guam. And then, of course, we work with a lot of people that have left Guam, live in the States as well. So I'm here, a couple times a year. Love to get here more often. So, of course, looking to expand here. So.
Right. And Dave's an Arahan boy, local boy made good, right? So congratulations on that. Dave, I really appreciate you spending time with us, and I look forward to seeing you continue on your journey and hitting those 10x returns.
Great to be here, Ryan.
More, but as a baseline, right? Yeah.
You didn't say about when, though. So
yeah, exactly, right? Yeah, the time horizon.
Yeah, exactly.
But thanks, Dave, and thanks for joining us on Market Movers. Look forward to talking to you soon. Can we talk about the economy? Dave, can you talk to me about what you think is the economic outlook moving forward in 2024?
Well, that being said, I'm not an economist, but it seems to be that the Fed has done the impossible, right? This soft landing, here we are. And, when people ask me about the economy, it's almost like, well, which economy, right? I think, at this very table, we're talking about Guam, we're talking about New York, we're talking about nationally, internationally. And so, we work with, a lot of different families and have kind of insights into their businesses and careers. And so, there's very disparate experiences going on at the micro level. But I think we always want to kind of look at the fundamentals and what matters from our perspective, really, as how does it, what's the result on the markets, right? And so, valuation matters. And at the end of the day, it's profitability for these companies that's most important. And so, there are companies that are going to make money in a good economy and a bad economy, and vice versa. So yeah, you're not going to get any sort of predictions about me from me about 2024. I think that we put portfolios together and think about worst case scenario and likely the probable case scenario, and then kind of build it that way, right? And so whatever the economy is, because we're not we're not going to time this market. So.
Okay. What about at the local level now? What are you seeing?
Well, at the local level, I think building off of what Dave was talking about with regard to the Fed, there's a couple other things we look at are what's going on in Asia, in the Asian market, specific to tourism, right? And so our number one, our basically our two biggest contributors to our tourism economy are the countries of Japan and Korea. Right, and so Korea is a very agile visitors market. They during COVID, it was quick to shut down, but then once travel restrictions were lifted, it was quick to rebound. And we're seeing them approaching pre-pandemic numbers more quickly than Japan is. And with Japan, though, it's not just maybe how they feel about, it's not just necessarily how they feel about Guam, it's also a function of what's going on with the yen. We have a particularly strong dollar versus the yen at the moment, and that's why you see all of our buddies going on vacations to Tokyo and to Niseko and all of those places. It's a great time to go to Japan. But conversely, for visitors coming to Guam from Japan, Guam is becoming a more expensive destination relative to, like, let's say, Okinawa, right? When it comes to small businesses, I think if you think about it from a function of like, do they have access to capital, right? What I'm seeing is COVID created this opportunity for the federal government to dump a lot of money into economic development types of initiatives. So we were talking a little bit about our SSBCI venture capital program. That program would not have existed if COVID didn't happen, right?
Right.
And so now what we have is now, if you're looking to start a business, you have options. It's not just about going to the bank. And here in Guam, I think we don't really have access to like these VC funds and these popular sort of, or these a plethora of venture capital funds or places that can provide startup funding. So this is just one additional option. So I think there's more access to capital. Of course, the military and the defense sector continues to be strong, and because of the amount of emphasis that they're placing in this region continues to benefit our economy in the sectors of construction. But kind of like what David was alluding to, the experiences of the profiles across our residents is kind of bifurcated, because you have people who benefit from the work being done inside the fence, and the people who may be hurt by the work inside the fence. You have business owners who are losing employees, having to retrain employees because they're losing employees to the defense industry. In tourism, when a lot of those tourism-based businesses shut down, some of those employees, let's say landscape folks or outdoor security type folks, et cetera, they went to go work on the base, and now they're not coming back out because the wages are higher on base versus the tourism industry. So I think what's going to happen is we need to find a common ground, or kind of a way to go from here, and how to reset our local economy outside of the fence with regard to tourism, even with all of the constraints coming from Japan and Korea as far as how the Japan economy is doing, but to really find middle ground that makes it a competitive, complementary industry to the defense sector. I think that's what I think that's the heavy lifting we'll be doing in 2024.
Okay. Well, so I'm glad you brought up access to capital because that's something I'd like to ask you about, Dave. What do you foresee as the ability for the entrepreneur, the small business person, or just anyone in general looking to scale their business, respective to access to capital in the open market?
Yeah, I think because so many people want to talk about interest rates, right? And so. And historically, if we kind of look at what the Fed has had its Fed funds rate for the last 50 years, it's around 5%. And so, that's where we are now. Mm-hmm. And so, there's a lot of businesses, there's a lot of sort of real estate projects, or sort of startup businesses that are sort of they're feeling the effects of higher interest rates, and there's just waiting with bated breath in terms of when they come down again. And so, for us, we really have to take a firm look at, whether these businesses are sustainable in, what could be actually a normal interest rate environment, right? And so, while there's hints that the Fed will lower rates next year, we don't know the magnitude of that and for how long. And so, access to capital is really the name of the game, whether you're a business owner, you're a W-2 employee, or you're investing in real estate. And so, when it comes to real estate, I think for sure people have to double down and say, okay, well, there's nothing I can do about interest rate, but what is my comparative advantage? What can I do in terms of executing and appropriately buying projects and selling at the right time and managing it in tax efficient ways, and so it's really best to sort of just hone in on those different aspects of people's businesses and then go from there and focus on what they can control, because for our clients, if a client has a business or a real estate project that's highly dependent on interest rates for success, it's probably not a sustainable business.
Okay, what do you think is one thing that would help a local business be attractive at the stage of investor that you typically deal with?
Yeah, I think when it comes to business fundamentals, right, it's continuous improvement of the product and the service, right? And so, and when you do that and you just make that attractive to your particular market, good things happen eventually. And of course, you can expedite that process with really good marketing. And marketing essentially is you either throw a lot of money at it, a lot of time at it, or you be unique. And hopefully, you're all three. And then, of course, everyone's going to know about your business. So
okay. Well, what do you think the interest rate trend is going to be in the, where do you think we're going to be this time next year?
Yeah, you're not going to
$1 million question. Come on, Dave.
I think it's going to be the same, or they're going to cut it just a little bit, just a hair, not enough to be I don't think I've read many reports that have talked about anything more than like a 25, 50 basis points drop. Everybody's been hold or slight drop, but not significant.
Yeah, I mean, I think when you look systemically, right, I think, whatever the mistake the Fed did the last time, they'll kind of do the opposite mistake, right? So they keep it too low. They'll probably keep it too high. At the same time, just looking at the, amount of debt the U.S. government has, and from a Treasury's perspective, that with interest costs basically the size of the defense budget, we're all incentivized, and we all would love lower rates, right? Interest, sort of our personal lives from the government's perspective, it just helps in all different ways. Yet at the same time, that the Fed is very aware that they cause many of these bubbles, right? And so. I tend to agree with Mel in terms of just, we're not going to see a dramatic decrease in rates, but we're going to get some relief, gun to my head kind of thing.
Well, I literally did put a gun to your head, but thanks for that. I appreciate that. Well, I was talking to a commercial developer, like a legacy commercial building developer. And I was asking them, well, how do the interest rates play into your overall plans moving forward? And he said, well, we're moving forward. We don't look at rates. We just, if it makes sense, we're going to do it. And he said, I came up in a time where we're looking at 11%, 13% commercially. And we just know in the long term, these investments are going to pay off. And that's the nature of real estate. But I guess I asked because, in terms of anticipating what volume is going to be, in terms of anticipating what activity is going to be, in terms of anticipating what the outlook is going to be, because even though the economy of the national stage is very different from what we experience here locally, it doesn't mean that the consumers are not affected by the news and the consumer sentiment across the board. So that's why I asked, because that all bleeds into what is the consumer going to look at. If we're looking at houses at the $500,000 price point, those houses are primarily being bought by service members or were being purchased by service members when the interest rate environment was at 2 3/4. And that's because at that payment, it matched closely with what they were getting in allocation, and it made sense. And also, what a great deal, because I'm at that level. I'm buying, twice as much house as I could have bought a year ago, and that's a good investment because I can bank on that appreciation. But now, I think what you're seeing people gun shy about doing that because they don't have the long-term time horizon that you normally would. I'm looking at 3 to 5 years and I have to exit. And when I exit, I don't want to write a check, even though this is a quote unquote free money that I'm getting to pay to service this debt that I'm accruing. And then also
it's a concentration. It's the concentration of risk.
Yes.
Really is what it is, right? Because you have a service member who there was a pretty steady reliance on the fact that these military members would still come through and the home prices would maintain or even go up by the time they left. But now there's uncertainty, and that piece of their portfolio is larger than they would if in an unsubsidized environment be able to afford. Perhaps is what I'm thinking. I don't know.
Right, but the existence of the subsidy is a great safety net if you're getting into real estate in terms of understanding that at a minimum I'm going to have this right at the baseline, and in terms of like being able to sustain that debt service and sustain my investment. So I asked you this, right, Dave? I understand that every person that engages with you has a different financial portfolio, right? But understanding what you understand about the local real estate market, understanding what you comparatively the opportunities available to you as a financial advisor, planner, real estate or stock?
That's funny. That's the question, right? I think this is the time like we really sharpen our pencils, right? So there's so many times I've heard situations where people are like, oh, well, I'm going to buy this property, I put X amount down, it's cash flow positive, right? That's great. I should buy it, right? Just cash flow positive? Well, no, you should. should like model that out, understand what your assumptions are on vacancy and occupancy, and what are your repair assumptions, and what are the increases in rent you'll get along the way, and what would you assume that you'd sell it for, and the tax bracket you'll be at that point. And then before that, like, are you really an real estate investor, right? Like, what are your goals? Right? Is your goal to put together a portfolio to replace your income with 20 residential properties over time, or is your goal to, because you have a comparative advantage with the contractors like at your beck and call, that you're that one person that can kind of renovate a property in this environment, and buy something that's undervalued and then turn it around and flip it. And so I encourage people to think about stocks versus bonds versus real estate. It's really a capital allocation thing, right? And so you may think of it as sort of three buckets, right? You have sort of your safety assets, which are your checking accounts, your savings account, maybe even your home. Then you have your sort of market risk assets. That would be your 401k and your brokerage account. And then you have your sort of aspirational assets. And for many people, that's investment real estate. That could be your personal business. And so thinking through, like, what is the right weighting between those three buckets? And then, and you decide, like, okay, well, yeah, I'm a real estate investor. Well, then what is my hurdle rate for an appropriate real estate investment? Should I, real estate have tremendous tax benefits, both to sort of buy, manage, and sell, the ability to leverage up. I mean, there's so many good things about real estate. On the flip side of that, you can't really diversify in a real estate project, right? There's personal liability potentially. It's people throw around this term passive income, and it's crap, right? Like, it's real estate is real work.
Real estate stresses me out.
And so if you sort of look at historically at markets, you're like, okay, well, historically the stock market's done 9%, the bond market's done 4%. You put it together in a diversified portfolio, that's maybe 6%. 7%. Then what is your sort of incremental risk premium that you need in a real estate project to get you there? And so for some people, you're like, okay, well, I can earn sort of 6 or 7 in the markets, and the equivalent project in real estate world might be 9, right? And for some people, that's 12. And so any project that's sort of on a risk-adjusted basis, better than at that given time. I never sort of think of it as an either-or thing. These, real estate and liquid securities are complementary. So.
But leverage is built for real estate more than it is built for stocks and bonds. I mean, their ability to borrow, like at the entry level, right? It's a lot easier to go in and buy a really terrible fixer-upper of a condo than it is to give that for $150,000 or $200,000, whatever it might be. It's easier to borrow money if you have, a traditional background, kind of, an 8-to-5 job that is a steady paycheck, a job history, and all that, than it is for you to access $200,000 to put it in an equivalent investment in the stock market. That's what I mean. I think leverage is always friendlier to real estate. Historically, been friendlier to real estate.
Agreed, especially with the existence of government-backed loans.
Right.
You as a individual, I can buy a multifamily up to 4 units. I can live in one and get amazing financial terms amortized for 30 years. Plus, I can get 70% of the existing rental income added back to my qualification that will scale my ability to purchase that property.
Right. I was just looking at because I was doing some housing research for the Gov, and I was looking at the VA loan that you can buy up to 4. Same thing. You can buy up to 4 units with no money down in a lot of cases.
Right.
And in my mind, I was like, 4 units with no money down.
Thank you for your service.
I should have done my time in the military. What was I thinking?
Right, but and that's kind of the hot thing on the market. Duplex, triplex, fourplex. Everybody wants those because they understand that's where I can scale from, because after 1 year, I'm out of that and I'm on to the next.
Right.
So, but Dave, can you speak to? Fuck, I lost it.
I don't know what that is.
I had a point, but shit. Okay, sorry. But Dave, can you speak to when you're looking at financials for an investment property, what is the number one or top 2 things that you look for when you're looking at a P&L statement or analyzing real estate for potential investment?
Well, I mean, a lot of times we're doing this on behalf of clients, right? And so you have to evaluate the client first. Right?
Okay.
And so is this appropriate for this client in the context of everything that's going on with them? I think that, I have a certain bias against certain types of projects, right? And that's just my own personal bias. The fact that, you can buy real estate and, hold it forever, kind of depreciate it down, transfer to the next generation, get a step up in basis, and you may have gone 20, 30 years with paying very little or no taxes, right? And so, contrast that to a flip where, you put something together and you make the easy money, and then all of a sudden you're paying capital gains at 23.8. That's if you wait the 12 months, but if it's less than that, well, then you might be at 37%. And so you kind of do that again and again. It really eats at the returns, and we've modeled that out again and again and again. So, so what was your question?
Oh, well, so I'll sideline, right?
Yeah.
We had spoken when you were analyzing IRR is kind of like the, so I was hoping that you kind of speak to that,
yeah,
right?
Sure,
like
sure.
in terms of, so Dave, when you're looking at a profit and loss statement, what are some of the things that you're looking for in terms of analyzing that specific investment?
Yeah, I mean, I think the important thing is to put together projections, and I think I'm always skeptical of projections as well, right? So they're very diligent about the assumptions that go behind that, and on vacancy, on occupancy, on the repairs. What sort of depreciation are you going to get on that? Are you going to be able to get a cost segregation study where maybe you can depreciate a little bit faster, and then when you sell it, are you going to 1031 that afterwards? So just kind of being very diligent about that model that you're putting together, and understanding what that internal rate of return is on that particular project. Admittedly, I'm not a real estate expert. I don't do real estate investments on a daily basis, but we're helping people, giving advice and sort of what we know from our perspective, right? And sort of, we of course have our own personal biases. So.
You touched on internal rate of return. What is the internal rate of return?
Yeah, so it's just a mathematical formula, right? So if you're projecting out that the cash flows that give you the present value equal to your initial investment.
Okay.
So, for example, if you buy something for $100, you get $110 next year, the IRR is 10%, right? And so you can imagine, though, if there's sort of negative and positive cash flows along the way, it's going to make your model a little funky, but, that's where you can talk to your financial advisor or accountant, and they can help you out with that. So.
Yeah, Dave is the king of spreadsheets. So, yeah, I'm sure.
That's a good formula, though, on Excel to know.
Right. Yeah.
Equals
I know.
IRR.
Yeah, and just understanding what the inputs are and how to calculate it is definitely key. So I just wanted to thank both Mel and Dave for joining us. It's been an experiment, the 3-man setup. So you see us kind of squeeze in here, or maybe you don't if you're just listening at home. But I appreciate you all joining us, and look forward to talking to you next time on Market Movers.